The current value of my long-term dividend growth stock portfolio is $104,717. With $91,812 initial dollars invested, this puts my total return at 14.06%. I've built this account primarily over the past 3 years, and I'm still positive despite the current 2022 stock market crash. Year to date, the S&P 500 is down over 21%. This has provided buying opportunities and a chance to rebalance my portfolio, which I discussed in my last portfolio update. Currently, I own 17 stocks in this portfolio. Today, I'm going to analyze my top 10 dividend stocks. With each, I'll give my updated investment thesis and a bull bear case. On top of this, I'll share all my recent buys and dividends coming in. Let's roll the intro. My name is Zach, and you should leave a like and subscribe to the channel if you enjoy the video. Every month, I analyze the progress of my long-term dividend growth stock portfolio. These videos help hold me accountable and clarify my investment strategy. Hopefully, they can serve as a source of motivation for others as well. If you want to track your portfolio and dividends just like me, then sign up and become a member of my website, dividenddata.com. I've made a bunch of improvements in recent weeks, most notably to the user interface. It's now far better optimized for smaller screens and mobile platforms. Additionally, I added a new projected annual income view on the income page as shown in my most recent video. One big feature that is currently in development is the automatic linking of your brokerage account. You can see the development version here. This is not yet available to Dividend Data members, but it will be released as soon as it's ready for the initial rollout. In addition to portfolio and dividend tracking, you can gain access to my stock research tool, which you will see throughout the video. Your support is appreciated. Now let's dive into my portfolio. Everyone is in a different phase of life. I'm currently 23 years old and have a long investment horizon. It's for that reason that I prioritize long-term dividend growth and total return. I want to invest in businesses with competitive advantages that can grow their dividend payments year after year. In order to accomplish this, a company must have a sound business model and generate large free cash flows with opportunities for continued growth. I prioritize stocks that are able to reward shareholders with both dividends and share buybacks. Before I analyze my top 10 dividend stocks, let's briefly go over my dividends and recent stock buys. My current projected annual dividend income is $3,016.53. This is an average of $754 every quarter, $251 every month, $8.26 every day, and 34 cents every hour. Here you can see the schedule of my payouts, which is not very even, but that's fine for now. This month of November will be one of my lower months, but December will be a great end to the year. Here you can see my upcoming dividend payments. Enterprise Product Partners and Texas Instruments will be my larger dividend payers in the month at $54.44 and $33.48 respectively. December will be led with huge dividends from both Intel and Exxon Mobil. Since the inception of this account, I've earned $7,008 in dividends. Year to date, I've earned $2,792. Over the past 3 months, my rolling average is $280.77. This is set to go down because of my rebalancing, which I discussed in my portfolio update last month. Check that out for full reasoning on some of my buys and sells. Here are some of my latest buys. Since my update last month, I've purchased $2,847 worth of stocks. This was led by 10 shares of Microsoft at a cost per share of $227.74. Also, I bought 2 shares of Texas Instruments at a cost per share of $155.97. Finally, I bought 10 shares of Intel at a cost per share of $25.77. These purchases bring my portfolio to the state you see today. Now let's get to the topic of the day, an updated analysis on my top 10 stocks in my long-term dividend growth stock portfolio. Warren Buffett once said, Everybody, when they buy a stock, should be able to take out a yellow pad and write down exactly why they plan to invest in that particular company. So today, I'm going to write down my investment thesis for my top 10 stocks. On top of this, I'll share some of the competitive advantages along with a bull and bear case of each stock. I think this will be a great mental exercise and suggest you follow along at home with your own portfolio. I will go in order of value from highest to lowest. Stock number 1 is Microsoft, ticker symbol MSFT. My current value is $20,884. I'm down just over 9% on the position. The overwhelming majority of my Microsoft investment was over the past 2 months. The stock price now sits around its 52-week low. Based on my buying habits, I obviously think this is a good long-term buy right now. So let's get to my thesis. I'm buying Microsoft at the current price because I believe the company will reliably grow its earnings by an average of 10 to 15% per year over the next decade. This will fuel a similar dividend growth rate and share repurchases in that period. Microsoft is a rare company where I see every business segment they operate as a growth business. The primary growth drivers will be intelligent cloud, including Azure, and Microsoft's productivity and business software. An investment in Microsoft is an investment in the growth of software development, web applications, data, AI, and all future enterprises that will be spawned from their digital infrastructure. On top of this, Microsoft provides the software to help these current and future businesses grow. They even help connect them with talented employees through LinkedIn, which is the dominant social network for professionals. I haven't even mentioned their ownership of GitHub, Xbox, and oh yeah, Windows. Microsoft is a focused company with dominant positions across sectors experiencing long-term secular growth trends. Microsoft has many competitive advantages across its business. First, there is the Windows operating system, which has 75% PC market share and provides an open platform for both users and developers. This ecosystem allows them to bundle and integrate their software services with a large user base. For example, the Microsoft 365 subscription with their Office suite is giant for both enterprises and consumers. This applies on the software development side as well, with tools like Visual Studio and GitHub. GitHub specifically benefits from large network effects. Finally, they leverage their enterprise relationships, brand, and developer tools to accelerate their cloud growth with Azure. Microsoft has joined Amazon Web Services as the 2 top players in this space. As a top cloud provider, this means increased software developer usage, documentation, and resources. Additionally, these services have a large lock-in effect where companies are unlikely to switch to another provider. At a certain point, it becomes too developer intensive to switch from one once you're integrated into the system. My bull case for Microsoft is that they grow earnings even faster at a 15 to 20% range as they have in recent years. Also, in this case, all the competitive advantages I just explained remain and expand. On top of this, artificial intelligence may increase the rate of software development, fueling all their current growth drivers. This is actively being worked on by Microsoft through GitHub Copilot and their investment in OpenAI. If you know, you know. The major bear case for Microsoft would be that cloud becomes a highly competitive race to the bottom, Windows declines as an operating system, their Microsoft 365 subscriptions become uncompetitive on the market, or the nature of computing itself changes in an unpredicted way. In the short term, there are minor bear cases such as a slump in PC sales following the pandemic-induced work-from-home surge. Additionally, since Microsoft is a global business, there are currently headwinds from foreign exchange rates. Also, there is risk of regulations, such as a possibility of governments not allowing their acquisition of Activision Blizzard to go through. Microsoft is a stock I will continue to add to if it drops in price or stays in this current range. I plan on this being a core pillar of my portfolio into the future and will keep buying for the foreseeable future. I'll likely create a full Microsoft stock review video in the coming week. Subscribe and stay tuned for that. Stock number 2 is Exxon Mobil, ticker symbol XOM. I have 155.39 shares at a current value of $17,452. I bought this stock in 2020 and my total return is 209.42%. My thesis for buying Exxon Mobil is that global energy demand will continue to increase over time and oil will play a large role in that for at least the coming decades. Additionally, petrochemicals will continue to play an important role in creating products for modern life. Although a slower growth business, I expect Exxon Mobil to generate large cash flows and reward its shareholders shareholders with a consistently growing dividend and occasional share buybacks. ExxonMobil has grown its dividend payment on an annual basis for over 40 years. I expect this will continue despite the cyclical nature of their commodity-based business. ExxonMobil has a rock-solid balance sheet with the cash to continue paying their dividend during periods of low oil prices. This was proven during the recent 2020 collapse in the price of oil. I used this as a buying opportunity and picked up my investment position at a great value, knowing that the price of oil would eventually rebound. I locked in a fantastic dividend yield on cost of 8.6%, not counting their recent 3% increase. From reinvesting my dividends, I've gained 17.39 more shares, boosting my dividend yield on initial cost to 9.69%. Now that the price of oil has rebounded and hit highly profitable levels, ExxonMobil is raking in cash to help rebuild their balance sheet. As of the recent Q3 report, they have $30 billion in cash on hand and generated over $19.5 billion in free cash flow in that quarter. For context, their quarterly dividend payment is $3.68 billion. This was a number once thought to be unsafe. ExxonMobil's dividend and financial future is now secure for many years to come. This is a stock I plan to hold for the long term. However, I am not buying ExxonMobil at the current price. This is because the stock will likely see a large decline when oil prices cycle down once again. I cannot predict when this will happen though. My intuition is that oil will stay at highly profitable levels at least through 2023. My strategy is to buy at times of pain similar to 2020. During these times, the market can often react with a highly short-term mindset. In the meantime, I will continue to reinvest my dividends. The bull case for ExxonMobil is that they will be disciplined with their spending in their traditional oil business and generate massive cash flows to reward their shareholders. On top of this, they will intelligently invest to grow their future businesses. They are already starting to do this with technologies like carbon capture and biofuels. Carbon solutions can potentially grow into a massive business, and no company is better positioned to capitalize than ExxonMobil. The bear case for ExxonMobil is that decline in global gasoline demand happens rapidly before the company can grow other revenue streams. This is a fundamental risk to a large portion of their business, but it's unclear as the problem is likely 10 to 20 years from having a meaningful impact. Short-term risks are the commodity price of oil and how that impacts their profitability. The third largest stock in my portfolio by current value is the Walt Disney Company, ticker symbol DIS. I have 110 shares at a current value of $10,963. My total return is negative 33% as the stock has fallen 50% from its all-time high. It should be noted that the company has had their dividend payment suspended since the 2020 pandemic. This was due to their theme parks being shut down and movie theaters being closed. Disney is still included in this portfolio as I own the stock in the account prior to the dividend suspension. Historically, Disney has had a growing dividend and share repurchases. It remains unclear when this type of shareholder returns will come back. Disney was one of the worst hit companies from the pandemic, and they are just now starting to fully recover. On top of this, they are going through a business transformation as they grow their streaming services. These streaming services are seeing great growth, but currently at peak operating losses from high content spend. They are not expected to become profitable until the end of fiscal 2024. It's for this reason that the company's earnings have not returned to pre-pandemic levels despite their domestic parks now being more profitable than ever. Disney's top-line revenue is now the highest ever and it has a clear path for continued growth moving forward. I'm actually extremely bullish for the future of Disney. Looking back, I reached on some of my buys and should have waited for the financials to catch up. This is especially obvious given the complete market shift in 2022. So what is my investment thesis for Disney? I bought the stock because they are the most diversified media company with the ability to monetize their content more effectively than competitors. They own many of the top entertainment franchises in the world with passionate fan bases across Marvel, Star Wars, Pixar, and Disney Animation. These brands give Disney a core audience unrivaled by most traditional media companies. Streaming will be the primary growth driver over the next decade. Their three streaming services, Disney+, Hulu, and ESPN+, are already collectively the most subscribed to entertainment services beating out Netflix. This growth will continue, and they will be cemented as the dominant player in this space. Due to the strength of Disney's brands and their ability to bundle services, I believe they will have massive pricing power. This means that they will be able to raise prices over time, reaching highly profitable levels for the company. This pricing power is already being demonstrated with the announced streaming price increases, and it has been shown historically throughout their parks business. This streaming service will fuel Disney's monetization flywheel by increasing their brands, sending more viewers to their parks and merchandise. The Disney Plus membership will become more integrated into their other businesses over time. As an investor, this will lead to large free cash flow growth over the next decade, a return to growing dividend payments, and share buybacks. By 2024, Disney will exceed pre-pandemic earnings and then be growing to new highs. That is what I see as both the most likely and bull case for the company. Other cherries on top could be a new park announced or the acquisition of a new streaming service to add to their bundle. The bear case for Disney is that their linear television profits completely collapse in the coming years and they are never able to create a profitable business out of streaming. In a less bad bear case scenario, streaming profits are never able to exceed linear TV profits. These bear cases would break my investment thesis for the company. However, it will take a number of years to see if this plays out, making Disney a riskier investment and disliked by the market at the current moment. Stock number 4 is the Altria Group, ticker symbol MO. I own 198.87 shares, currently valued at $9,049. This is my largest dividend payer, generating $747 in annual dividend income. I have an 8.88% dividend yield on cost and a compound yield on cost of 9.6%. My total return with dividends reinvested is 16.21%. My investment thesis for Altria is that they will continue to generate reliable, slow-growing free cash flow. This cash will be distributed to shareholders via both dividends and share buybacks. In this scenario, I will see a great return on investment from dividends alone. Altria has grown its dividend payment for over 50 years, and I expect this will continue. They just had a 4.4% dividend increase. Based on free cash flow, these dividend payments are sustainable. The Altria Group is a tobacco company who owns the top cigarette brand Marlboro and other top brands across oral tobacco and cigars. They also have strategic investments in alcohol, marijuana, and Juul. Juul turned out to be a terrible investment as it has now been banned in the United States. These brands give Altria pricing power, allowing them to continue increasing margins and profits despite decreasing smoking rates. The bull case for Altria is that their tobacco business remains a steady or slow-growing cash cow for the company. Beyond that, they could introduce a new vape product. However, the biggest bull case for Altria is the eventual federal legalization of marijuana in the United States. This could be a massive growth business for them as they've already invested some into the space. If they play their cards right, Altria could become a giant, leveraging their existing distribution for cigarettes. The bear case for Altria is regulation. This was just shown with their banning of Juul, causing them to fully write down their massive investment. In my opinion, that was obvious targeting, given similar products are still approved by the FDA. The killer for Altria would be an outright banning of cigarettes in the United States. Now that would be ridiculous in my opinion, but it does present a small risk. Other than regulation, there's the underlying trend of decreasing smoking rates, which the company has been already dealing with for decades. Stock number 5 is Apple, ticker symbol AAPL. I own 47.39 shares, currently valued at $6,558. This gives me a 12.9% total return. In my opinion, Apple is one of, if not the highest quality company in the world. They have the best brand, massive customer loyalty, and an integrated product ecosystem that creates a huge competitive advantage. My investment thesis for buying Apple is that the company will grow their free cash flow at least an average of 10% per year over the next decade. This cash will continue fueling their large share buyback program and lead to future dividend increases. I think it's likely that the iPhone will remain the dominant smartphone and the largest part of Apple's business. However, growth of that product will slow due to its large existing presence in the market. This will be made up for with the growth of their services business across Apple Music, news, podcasts, TV, fitness, health, etc. Additionally, the company will continue launching new products to add to their ecosystem. In recent years, so many new money printing products have been added. There are the AirPods, Apple Watch, AirTags, etc. Future products may include augmented reality or virtual reality glasses, the Apple Car, and likely more products we're not even thinking thinking of. The bull case for Apple is that they continue to grow free cash flow and earnings closer to the 20 to 30% range they have in the past 3 years. This is by no means impossible. All it takes is iPhone strength, continued services growth with price increases, and a hit product that has not yet been revealed. Under that scenario, I would say that Apple is dramatically undervalued at the current price. The bear case for Apple is that iPhone growth stalls out and even has years where it declines. Beyond that, there would need to be significant disruption to the technology market that could change the relevance of the smartphone itself. Additionally, that product would need to not be something Apple can convert its user base to. Apple is such a ridiculously strong company that it's difficult to even imagine a decline from the current state. If there were small declines in Apple's earnings, it would likely be due to macroeconomic factors and not a core disruption in their business. Stock number 6 is Intel, ticker symbol INTC. I own 228.44 shares, currently valued at $6,442. My total return is over negative 15%. This is a semiconductor company which I've been buying recently and think is a great value. It's down over 58% from its recent all-time high. The dividend yield at the current price is 5.18%. For me, this is now one of my larger dividend payers with a projected annual income of $333.53. However, Intel has a strong level of risk as they are investing heavily to transform their business over the coming years. My investment thesis for Intel is that they will retain their dividend in the next few years as they invest in opening new chip fabrication plants and growing their external chip foundry business. Demand for semiconductors are expected to double over the next decade. As a top manufacturer, I expect Intel will be a key part of meeting that demand. My investment thesis for Intel rests on the expectation that they can remain a top manufacturer, making gains against rivals Taiwan Semiconductor and Samsung. Additionally, they need to retain and hopefully grow their Intel design chips, holding off competition from other designers like AMD. If they can do this at a minimum, then I think Intel will return to generate significant free cash flow growth, which they can use to grow its dividend and bring back share buybacks. This will lead to very respectable total returns at the current price. Similar to Disney, the success of this transition will not be known for many years, making it a riskier investment. The bull case for Intel is that their foundry business grows to be as large as their current client computing and data center business over the next decade. If accomplished, this would be a massive improvement and set Intel up in a dominant position moving forward. This diversifies their business and takes advantage of their manufacturing infrastructure, which is their true economic moat. In this scenario, Intel can manufacture for designers like Qualcomm, Broadcom, Microsoft, Apple, Amazon, and even their main CPU and GPU competitors, AMD and Nvidia. This makes Intel a foundation of the chip business and takes away the risk of being outcompeted on design. That foundation could make Intel a growth business for decades to come. In the super bull case, Intel could benefit from foreign conflict like China invading Taiwan and making TSMC toxic for American companies. Intel would be set up as the main manufacturing beneficiary in this scenario. On top of that, you have the CHIPS Act, which will help fund Intel's expansion into domestic manufacturing. The bear case for Intel is that they spend massive sums on building new manufacturing capacity, but face demand issues. This could be from a dramatic loss in market share to AMD in CPUs, or the inability to find customers for their new foundry model. This would make the huge spending basically worthless and lead to massive financial troubles for the company. Another risk is that despite massive spending, they prove to be unable to compete with TSMC's foundry manufacturing model. These risks seem low probability as Intel is already signing foundry contracts and they still have dominant market share to AMD and are often quite competitive depending on the product generation. I'm buying Intel at the current price because I find the risk-reward proposition to be quite attractive. In the meantime, I'll get a strong dividend to reinvest at these low prices. This is a long-term holding. Stock number 7 is Federal Realty, ticker symbol FRT. I own 45.05 shares, currently valued at $4,734. My total return with dividends reinvested is 49.58%. This is a real estate investment trust that I bought during 2020 when there was a massive worry about rent collection across the industry. When I bought the stock, I locked in a 5.6% dividend yield on cost. From reinvesting dividends, I've grown my yield on initial cost to 6.15%. My investment thesis for FRT is based on the quality of the real estate holdings and the reliability of the dividend. FRT is a dividend king with over 55 years of consecutive consecutive dividend growth. Although growth has been slow since the pandemic, they showed resilience while similar REITs experienced dividend cuts. They accomplished this through diversified income streams, a strong balance sheet, and focusing on the quality of the real estate. FRT's strategy is to invest in first-ring suburbs of high-barrier markets like Boston, New York, Washington, D.C., Miami, Silicon Valley, and Southern California. They want densely populated areas with strong household incomes and flexible property formats. Their average household income in their regions are over $151,000. They combine this with diversified categories and tenants across their mixed-use properties. I do think that FRT can see growth in the coming decade. High population, high income, and high barrier to invest. High demand and limited supply of quality real estate. This is a formula for increased rents and property values over time. The bull case for FRT is that they can reaccelerate dividend growth back to a 5% average it had in years past. The bear case is that growth remains slow moving forward and they face short-term rent problems due to the macroeconomy. Also, they do have some exposure to the commercial office space, which has been dramatically impacted by the work-from-home movement. This may impact some of their properties and will likely impact their future investments in that category. Stock number 8 is Texas Instruments, ticker symbol TXN. I own 27 shares currently valued at $4,391. This is a stock I've been buying a lot of lately and I'm looking to make a core position in my portfolio. It now generates $133.92 a year in dividend income for me at a 3.13% dividend yield on cost. My investment thesis for buying Texas Instruments is that I can expect high free cash flow growth averaging 5 to 10% per year over the next decade. This will be rewarded to shareholders via both high dividend growth and share buybacks. Texas Instruments has a dominant position in the analog semiconductor market. As of 2021, they have the largest market share at 19%, which is 7% higher than second. Texas Instruments designs and manufactures these chips. The company has a great balance sheet with $9 billion in cash on hand and negative net debt. Over the long term, Texas Instruments will benefit from the growth of the overall semiconductor market. However, they will face less competitive forces and require less capital investment compared to digital semiconductor manufacturers like Intel and Taiwan Semiconductor. The bull case for Texas Instruments is that they remain disciplined investing and capture a large segment of growing demand for analog semiconductors. Free cash flow growth could reach as much as 10 to 15% per year. The bear case is that Texas Instruments could lose market share to a competitor. Also, macroeconomic forces could lead to short-term earnings decline or a slowing of growth. This is already being experienced and anticipated in the semiconductor market, which is one of the many reasons why the stocks have been trading down lately. Stock number 9 is Kroger, ticker symbol KR. I own 83.19 shares, currently valued at $3,860. Kroger pays me $86.53 a year in dividends, and my yield on cost is 2.88%. My investment thesis for buying Kroger is based on it being in the stable industry of grocery, it being a diversified business, and having fast-growing dividends. Kroger's dividend is growing at a 14.8% compound annual growth rate over the past 3 years. They just recently announced a 23.81% dividend increase. The company still has a low payout ratio of 35% and has had strong earnings growth in recent years. The pandemic has accelerated their digital and e-commerce business, helping shore up one of their possible disruptions from competition. Kroger as a business is not just the Kroger store brand, but they're a conglomerate of various grocery chains. In fact, this is about to expand even more as Kroger announced they will be acquiring grocery conglomerate Albertsons in a $24.6 billion merger. This is combining the United States' 5th largest retailer Kroger with the 10th largest retailer Albertsons. If approved by regulators, this will make Kroger a grocery super company. Now, I'm not going to go into the specifics of this, but this acquisition helps drive home one of the reasons why I like Kroger. I like their specific focus only on grocery and their diversified branded stores. On top of that, they connect these stores using the same digital infrastructure, private label products, and delivery fulfillment centers. The Albertsons acquisition will add to their massive portfolio of private label brands, and Kroger will be able to leverage their technology to enhance Albertsons stores. Also, there will be cost savings associated with the merger. It shores up their position and allows them to compete better with the likes of Amazon, Walmart, and Costco. The bull case for Kroger is that they become the dominant grocery company, uniting their stores with e-commerce and private label products. Also, they continue to invest in technology and automate both in-store and fulfillment centers. If operated effectively, this will create a wide moat with growing dividends and large share repurchases. The bear case for Kroger is that they are outcompeted by e-commerce first companies like Amazon or the continued growth of membership big box retailers like Costco and Sam's Club. However, I do think there is simplicity to the grocery-only business that Kroger will benefit from. Stock number 10 is Chevron, ticker symbol CVX. I own 20.14 shares, currently valued at $3,695. My total return with dividends reinvested is 116.36%. Chevron pays me $114.43 a year in dividend income at a 5.99% dividend yield on cost and 6.7% compound yield on cost. If you want to know my thoughts on Chevron, basically everything from the Exxon section applies to this. There are slight differences such as the cost of production, where Chevron has a slight advantage. However, Mobil has a larger chemicals business and is invested more in biofuels and carbon capture. The rest of the stocks in my portfolio are PepsiCo, Visa, Enterprise Product Partners, T. Rowe Price, McDonald's, Coca-Cola, and Realty Income. If you want to know my updated thoughts on these, then check out some of my other videos where I've analyzed the stocks. All of this is just my opinion, so be sure to do your own research before making any investment decisions. Thank you for watching Dividend Data. You can sign up for dividenddata.com to track your portfolio just like me and join a Discord community of like-minded investors. Also, you can get access to the research tool I use throughout the video. Follow me on Twitter for real-time dividend news, and thank you for watching.